partnerships. Partnerships can be awesome or they can be awful. You need to know how to structure your partnership so that you don't get into it without a way to get out of it. You know, I think of partnerships as something that can be great, but I also like to know how I'm going to unravel it before I even get into it. It's a lot easier to have a plan before you actually get into something. Would you not agree? Well, Adam here is going to teach you exactly how to do that. We're going to go over partnership structuring and everything that goes with it. And I can tell you, I've made a lot of mistakes in my past, a ton of them that have cost me significant money. And that's what we're going to help you not do. So Adam, welcome to the Wealth Webinar Series.
Thank you so much. I appreciate you all being here. The topic of partnerships, our lawyer in our office says it best. The only ship that is sure to sink is the partnership. So we always find ourselves doing business with friends and family members, and usually as people we love and trust. And it seems like we have these great ideas, we put it together, we go out and start doing deals and making money, and someone starts getting partnership amnesia. You forgot that you were supposed to do this, you thought I was supposed to do that. We start having all kinds of problems. So the goal today is I have this presentation that I want to share with you to talk about how to properly structure agreements and things that you should have in these agreements, different ways we can go about doing business with other people, but doing it in a way that is responsible to ourselves and our family, to make sure that we don't have problems later on. And I was thinking about one of the greatest things in real estate investing is that all the time people are looking to build a legacy, to pass.
Oh, looks like Adam, you froze a little bit there. Oh, well, hopefully Adam comes back on, but you know, he was talking about legacies and we'll wait till he gets the internet fixed up. But let me ask you real quick, while we're waiting for Adam to come back online here, how many of you are in a partnership now, have been in a partnership, or plan to be in some type of a partnership? So if you're in a partnership, put I. If you plan to be in a partnership, put we. I just want to gauge who's already in a partnership, and I don't mean a relationship, but it is a relationship, but a business partnership, and how many of you plan to be in a partnership. So we got I and we got we, I. Okay, awesome. So we got a bunch of people looking to do a partnership, whether it's real estate or other businesses in the future. So this is great. Adam, you back?
Yep, I'm here.
All right.
Thank you.
We got there's a little delay on your internet too. Are you on Wi-Fi?
Yeah.
That's okay. If you pause, I'll just kind of kick in and go.
Okay. It usually works perfectly. So apologize for that.
Murphy's Law.
Thanks for bearing with the technology. So there is this specific example a few years ago where there's a farm in Colorado that was passed on from generation to generation. And it started with the great grandfather that owned the farm. He passed away, passed it on to his 3 children, who a couple of them passed away, passed it on to their children. And as we go down the line now, we've got all this farmland that's divided up between 100 different siblings, and they couldn't do a darn thing. They had a little tiny piece of a farmland, and what parcel they had, we don't know. Just turned into a nightmare. So things that you want to think about as well as you're building your estate plan and your legacy is also being considerate of the fact. My father, for example, he sold his house and he says, "Yo, we're going to buy some land up in Utah. It's a beautiful area up there, and I want this set up so that when I die, this always stays in the family. It's in an irrevocable trust that can never be changed." And I thought, you know, that sounds nice. I like the thought. I like the idea, but it's really not a good way to handle things. So to start with, let me share my screen real quick. Presentation started. Can you see that okay, Chris?
Yep, there it is. Yep. Just got to maybe blow it up, make it a little bigger, and we're ready.
Got it. Okay. So on the partnership structuring, I'm going to start with the active partnership of how we're going to structure this when we're doing active business. Later on, we'll talk about how to structure passive investments. But this would be for any active income producing business, wholesaling, rehabbing, any of the regular business. We're going to talk about how we're going to do it. So the best way to start with, and as we go through this, we'll talk about joint ventures, partnership agreements, things that we want to have in place in these critical agreements as we put them together. But the first thing if you want to take a picture of this, because I don't have this to share with you right now, but the LLC tax as a partnership is at the top of the diagram. That is the business that goes out and does the deals and makes the money. As that company starts making money, the profits will get distributed to partner A and partner B, who should have their own LLC taxed as an S corporation, so that each partner can expense or invest their portion of profit however they choose. And again, the benefit of having the LLC taxed as an S corp is then each partner can choose how much W-2 salary they want to take, how much K-1 distribution they want to take. And our general rule of thumb is that we want to take no less than 30% of the net profit as a W-2, and then the rest of the money we pay to you as a K-1 distribution, which significantly reduces your Social Security and Medicare taxes. If all we did was set up the LLC tax as a partnership and you were doing active income, each partner would be responsible for state, federal, and Social Security and Medicare tax on any money that they would receive from the LLC tax as a partnership. So we'll talk about this a little bit more in depth. So the healthy partnership is to always have an LLC. And the LLC is, we have all this flexibility of how we want the LLC to be taxed. So if I set up an LLC and I have a real estate rental property, for example, that's just owned by me or me and my spouse, then that LLC can be disregarded, meaning it will not file a separate return. All the profits and losses will flow through to me personally. However, if I have a partner other than a spouse, I like for the LLC to be taxed as a partnership. We saw earlier that's files form 1065. All that does is tell the IRS, where did the profit or loss go? And with the LLC tax as a partnership, we do have, even though we may be 50-50 partners, we don't have to distribute profits or losses based on ownership. So if we're in business together, Chris, and I'm doing a little bit more work and I'm deserving of getting more of the money, we can make sure that even though we're 50-50, I have the ability to receive more of the profit than you. If we had an LLC taxed as an S corporation, we do not have that flexibility. Profits and losses must be distributed as based on the ownership. So it allows for a lot of flexibility with the LLC being taxed as a partnership. But we also want to make sure that we have a partnership agreement and a buy-sell agreement. So let me cover some of the details of what goes into those. Everything, and we want absolute clarity. All of these things we're going to lay out, and always remember that saying, the dullest pencil is always better than the sharpest mind, because having things in writing is absolutely critical. And as I traveled around the country working
All right, folks, one sec here. We just got to get this internet thing situated. So Adam, it keeps breaking up pretty bad. So like,
yeah, let me see if we can go to another room here. Hang on for just a second. I'll be right back with you, Chris.
No worries. Yep. And then Ronnie had a good question that I'd like to hit when we get back about wouldn't it be better to create a business trust? So that'll be an interesting one. But you know, here, as we're waiting here for Adam to come back online, we just want to make sure we get a clean recording of this. You know, I've had, I don't even know how many companies I've set up. Let's just say it's 16. I think it's more than that now, but we'll go with 16 because that's enough to kind of make your head spin. And in the beginning, when I was doing it, I didn't have good counsel. I didn't have good advice as to what to do. So I'd set the LLC up, and then, somebody once, I was doing a partnership. They said, "Do you have your operating agreement?" I'm like, "What's that?" And they said, "It's, there's a set of the rules. It's a set of rules for your company and how you and your partner are going to operate. Who's doing what? Who's going to take care of this?" And I'm thinking, well, I don't know. I mean, he does this and I do that. And if I can't do this, he does that. And like, that just shows you, like, most businesses, when they're set up, like, there's no set of rules. But I mean, if you think about it, if you're getting into a partnership, it's because the person you're getting in partnership with has a skill set or something you need that you're not good at, and vice versa. So like that operating agreement is so important to do, and the proper structuring of this partnership is very important, because don't make the mistakes I do. And then when something happens in the business and you're trying to dissolve the business, get out of the partnership, you're circling back and then there's no clear defined rules. So Adam, I was just kind of talking a little bit about my mistakes I made in my early years, but yeah, let's roll right back into it now that you got some good internet.
And I'm hoping that we're in a much better spot now. I just changed over to another conference room. So, we were talking about, let me share the screen back with you again real quick.
Maybe just go back one slide before, just because we were breaking up really bad.
Okay, let me get this in here. All right. So we were talking about the healthy partnerships and the pieces that are going into it, right? Is this where we're going to start here, Chris?
What was the one right before this one?
We have.
Yeah, LLCs, I think probably start here, because you were definitely breaking up a little bit.
Okay, and yeah, let me know if we have any issues. So the LLC has all this flexibility. So even though you and I might be 50-50 partners, we have the ability to distribute profits differently. So if I'm doing more work, I can take more of the profit. If you're doing more work, you can take more of the profit, even though the ownership is 50-50. If we had an LLC taxed as an S corporation operating our business, we would not have that flexibility. We must distribute profits through an S corp, must be based on ownership. So the LLC tax is a partnership, and how we make these tax elections becomes a really big deal in terms of tax savings. So I want to start with getting details about the partnership agreement and the buy-sell agreement. So when we talk about documenting everything, and I clarified in there that the dullest pencil is better than the sharpest mind. And we just want everything in writing on who's doing what. When are we going to distribute profits? What if we have to put money? All of these things have to be documented. But the amount of money we put into a business, we might start off with a deal thinking that we're putting each 25 grand in to help cover repair costs. And all of a sudden we realize that there's an oil tank that's going to cost us 30 grand to get removed, and we need more money. We have to have those things in writing. If that happens, how are we going to do it? I was talking to a guy in Michigan where he had a partnership. The one partner is a general contractor. He was doing all of the work himself, and the partner was expecting to get paid as though they had hired a contractor. So he's doing all the work instead of doing contracting work for other people. He's doing it for their partnership, and the partner expected fully that that work he was doing didn't mean anything. We're still going to split the profits 50-50. It should have been talked about. It ended up we actually had to shut that company down because in starting, they didn't have these things in writing, and it all has to be discussed. How much time you're going to spend, how much you're compensated, specifics on loan repayments, which can turn into a nightmare if each of us are putting money into the business as we get it set up and operating, and all of a sudden your partner has financial problems, IRS problems, divorce problems, and they need their money back. We have to have this documented. Is that money locked in there for a while, or when are we going to put it back? These things all need to be talked about. We already covered the specific distribution for profits and losses, but it's also to make sure that we're not both doing the same things. And I think we oftentimes with partners, we don't talk about, okay, I am not a tech guy. And Chris, if you and I are in business, I would make sure that I am not doing anything that has to do with technical expertise, not my area of expertise. Those would be
You
things that
certainly wouldn't want to partner with me if you were looking for someone that's good at tech. Just saying.
All right, fair enough. So that there's different strengths that we always have. And by breaking those job responsibilities out and documenting that in your partnership agreement, it will help to eliminate duplicity, making sure we're not both doing the same things. There's some things that we might both want to do, but a lot of things that we want to stay in our lane. There's so many tasks that need to be done for different businesses that breaking up those job duties can really help you tackle a lot more. So bottom line is we have to be specific on everything. And of course, there's flexibility. What we put in writing now can certainly change down the road. If I ended up taking some genius computer course and all of a sudden I became a tech genius and I want to start doing some of that stuff, we can. Is it likely? Probably not. But we could do those things and modify these agreements as time goes on. So partnership agreement is very important. I think even more important is the buy-sell agreement. This part of it is saved so many people or cost so many people a lot of money. And it's really the prenuptial agreement that says, okay, we're going into business together. If either one of us want out of this business for any reason, whether it's voluntarily or involuntarily, here's what we agree on now so that we are not in court later on. And the what ifs are always the things we have to tackle. So what if someone dies? Do I want to inherit my partner's spouse or children as a partner? Or if they're not married, they don't have any children, I might inherit a cousin, or who knows where the courts are going to give these ownership to. I could end up with some terrible partners. If there is a marriage or divorce, the divorce part of this is really helpful. And I have a client that was going through a divorce. They had a great business flipping houses, and business was going along great. And the partner went into a divorce situation, and the partner's spouse, of course, they both had their attorneys. The partner's spouse came in, saw all this money being made with flipping houses and the rental properties, and against the wishes of his ex-wife or soon-to-be ex-wife, the attorney came in and started attacking all of the business assets, saying, hey, just so you know, I'm going after this. We want half of everything. And thank goodness we had a buy-sell and partnership agreement in place, because the buy-sell literally saved us from having any of those issues. Because the buy-sell agreement was in place, the ex-spouse could only go after other assets, could not go after the business, which really saved everybody a lot of headaches. So, and they say statistically that 50% of marriages in the US end in divorce. Well, statistically, 80% of partnerships end in divorce. So this is a really big deal to have this agreement in place. There could be family issues, medical issues, bankruptcy. By having this in writing, this business, this LLC that we have, it's operating as our partnership, cannot be taken or affected by personal issues that you may have. And so several years ago, and this, I'm guessing this is back in 2008, 2009, I had 3 guys that came together that decided they were going to start buying rental properties. And as they bought those rental properties, they were going to save up the money they collected in rent and positive cash and buy some more and just start building out multifamily homes. So the first property they bought was a duplex. One of the units was empty, and one of the partners said, hey, you know what? Why don't I move into the other half? This is perfect. I'll pay rent just like a tenant would. Keep an eye on the property. It's our first one. It makes complete sense. So of course the guy moves in. They all did what's called a general partnership. They went to the bank, opened up the bank account. All 3 of them were there. They signed off. Lo and behold, a year and a half later, all of a sudden they had saved up about $10,000 in positive cash flow. It's all in that nice little partnership bank account. And all of a sudden, one of the partners goes to look at paying a bill, and the money is vanished. Money is gone. So immediately, what's he thinking? One of my two partners just cleaned me out. So he immediately gets on the phone, and they find out that one of the partners had not been paying his taxes properly as an independent contractor. And the IRS did a wage garnishment and actually came after, because his name and his social security number was on the bank account, the money was gone. The partner ended up moving out and eventually stopped returning phone calls. And the only way they were in a position where they wanted to refinance the house, the only way they could do it with that IRS levy against the property was they would have had to pay their partner's $70,000 tax bill in order to refinance the house and do something different with it. They should have had the LLC set up. It should have been in place. And you need to get these agreements in place while the skies are blue and we don't have problems. Once we start seeing problems arise, it's like when you're doing plumbing and there's a little bit of a water leak. We know that little leak later is going to turn into a big leak. So we want to make sure everything is nice and smooth. We have no leaks from the beginning is the best time to get these things in place.
Wow. Adam, real quick on that, that was an awesome story about that tenant. I mean, and I'm sure that happens for a lot of people, but I wanted to ask, you know, for all of you that have a partnership or are getting into a partnership, you know, did you know you had to do these things like the buy sells, the operating agreements? How many of you knew that these are things you had to set up when you create your company that's going to be a partnership? Just put in I if you already knew these things. I'm just trying to see how many of you knew this, because I didn't. When I first started doing this, I had no idea how this stuff worked, and I had to learn through the school of hard knocks. And I never had somebody move into a property, clean bank accounts out, but what I did have is I had a partner who ran one of my stores, and that was his store, and I ran the other stores. And what happened is we both signed on the lease for that. In 2008, when the market crashed, he stopped paying rent. Well, when the landlord didn't get the rent, and he kind of just packed the store up, shut everything down, took all the inventory, the landlord came after me. And I ended up having to pay this landlord for a period of 2 years. I had to settle out on what my partner should have paid because that was his store. It was kind of like a mini franchise, but I ended up having to pay that entire thing out. He took all the inventory in the store, sold it all out of his basement, never gave me a penny, and I got stuck with the bill. So it wasn't a rent, but it was similar. And it was because I failed to plan and I failed to find the right stuff. And also, Adam, one other thing I want to point out is with a buy sell. A buy sell is that set of rules. It kind of dictates what's going to happen. You know, and I asked earlier, you know, how many of you would want to be partners with your business partner's spouse? And all of you said no. Well, if you passed away and your business partner didn't have the money to buy out your family for the portion of that, you're going to be partners with your family spouse by default, because it takes money to basically do this. And even though there's a buy sell in place, if that buy sell is not funded, it's just a worthless piece of paper. If there's no money behind it to buy out that buy sell or buy out that other partner that passed away or that left the company, like that's no good. So also, you know, I want to make sure we kind of hit on the funding, because that was something that I learned very later, like after I kind of got going in this. If I were to have passed, I would want a life insurance policy that either the entity or my partner bought on me and vice versa, like a cross purchase, so that if I died, the money came to the company to buy out my shares. That way the life insurance paid to the company and the company bought out, you know, my family. So my family got all the money because it was set up that way. And vice versa. If my partner passed away, a life insurance policy would pay out to either the company or to me, that I then would buy his family out, because I don't want to be partners with his family, his spouse, and he doesn't want to be partners with my spouse. So the buy sell is great, but make sure it's funded, because an unfunded buy sell is just paper with a signature, and hey, it takes money to make money, and it takes money to make your business continue to operate. Sorry.
And that's a great point. Something that oftentimes people don't think about, which is exactly that. And when we're putting these agreements in place on that buy sell agreement, we can set out terms where maybe a $1 million policy was appropriate, but we simply couldn't afford it at that time. So we might have got a smaller policy in to cover each other. And the business might have been worth a lot more money. So we can set out terms and agreements of how long do you have to pay out my family? Is there interest involved with it, or appropriate interest involved? Those are all things we would document as part of that buy-sell agreement. It's a good point. So when we talked earlier about profit distributions and the flexibility of the profit distributions, a partnership allows us to distribute profits and losses unequally. And for most of us, we're not CPAs, but to give our CPAs the right tools to be able to do the best work is super important. So again, any LLC that I have a partner other than a spouse, I want to have that LLC taxed as a partnership, not being taxed as an S Corp, not being taxed as a C Corp in most situations. And of course, it's not a disregarded entity because we have more than one partner. So doing this, each partner will, as we talked about earlier, let me go back to this flow chart here. So each partner gets their own money. As our business, our LLC taxed as a partnership makes money, it distributes the profits, and then each of us can determine how we want to expense or invest our portion of profit. If we wanted to set up a solo 401k, we wanted to do it for retirement accounts, we can do those things through our own business without having to worry about the partner. Now, the IRS allows certain things that your LLC taxed as an S corporation can write off certain things. So for example, if I wanted to take and have a board meeting in Hawaii with my spouse, I could certainly do that. Is it a legally allowable expense? It absolutely is. However, it's probably not fair to my partner to have our partnership paying for my travel with myself and my spouse and our airfare and hotels and all of those things that are legally allowed, but it's unfair to the partner, so we don't do it. We start taking away tax benefits that we could get just to keep the peace with our partners. So that's why having the LLC taxed as an S corporation is so important to receive our portion of profit. So the LLC, not only my LLC can also build credit, which is another topic, but it can be used for any business venture. So maybe you and I have a business that we're flipping some houses, and I have another business venture with my partner opening up a gun store. My LLC taxed as an S corporation can have multiple streams of revenue coming in, and that's can be a huge advantage from a tax standpoint. People often don't think about this, but that LLC taxed as an S corp receives all self-employed income, or I should say most. There might be some businesses, if you're a doctor, lawyer, architect, engineer, those are professional corporations or professional LLCs that are only going to do that type of work. But everything that's not requiring those special licenses, we can run into one company, and it boils down to your risk tolerance level. But it's always a great option that you have for maximizing your tax savings. And step back and look what's happening right now. They're talking about raising our taxes significantly. And every time I hear about taxes being raised, I think about the poor people in California, New York, New Jersey. The taxes are already through the roof. I think in California right now, I saw that they're proposing a 16.1% personal income tax rate if you make, I think it was more than $5 million a year, where it's already at 13.1% state income tax for making over $1 million. These tax deductions become extremely important, and because it looks like the current administration is really trying to put some things in place to tax the rich people.
Adam,
so with that in mind, we got to save money.
I just was with my mentor today, which, some of you are going to meet at the experience event at my house, but Randy was telling me that in California, there's legislation, get a load of this. They're trying to, a lot of people are exiting California. They're moving to Texas, Florida, Salt Lake, Arizona, anywhere but California because of what you're talking about. California is trying to impose legislation and a law that says if you move, they can audit your records, your business records, and track your income for 10 years. Literally. So they're like holding you to those taxes, those California taxes for 10 years, even if you move out of the state. Listen, like New York's not the best place to live, but it's looking a lot better than California lately. I just had to bring that up. Oh, and also one other thing, like don't ever forget, and I know this is all kind of relative what we're talking about. The government, okay, is spending $80 billion of our tax money, just because you guys all know the government uses our tax dollars to hire 87,000. Bear in mind, let me just repeat that and let this fester. The IRS is hiring 87,000 IRS auditors and spending $80 billion of our tax revenue to basically go out there and make sure they squeeze every nickel, every bit of your $100 that you make, or 100,000 or whatever it is. Think about that and make sure that you plan properly so that these things don't happen to you.
That's a great point.
The scary point.
Well, and there was a new law that was just passed in California as well. I'd add this one in, that it used to be that when there was I think it was Prop 13 was in place, where if I died, I could pass my property on to my children and they would inherit the property with a step up in basis, and the property taxes would remain low because the appreciation goes up so much in California that if property taxes adjusted, it would be a nightmare. It'd be almost impossible to find someone to pay enough rent to cover those property taxes. They have just eliminated that loophole where when you pass, unless your child moves into the house that you were living in and makes it a primary residence within 6 to 9 months, that the property taxes will go up to fair market value immediately. It's going to crush a lot of the family planning that's going on to pass these properties on, because if you don't pay the taxes, you got 9 months, start paying the taxes or judicial foreclosure begins and they'll start foreclosing on these properties. So we certainly hope this doesn't go anywhere else, as it stays in California, but things we got to be aware of as investors, and especially being in real estate. So we're talking about earlier about having your own LLC, and we don't always have to set up an LLC tax as a partnership. You'll hear all the time people talk about just joint venturing. And I've had plenty of people that have had successful joint ventures where we go in, and I don't know that I'm going to do business with you on an ongoing basis, but to start out, let's go ahead and joint venture, and we'll team up, your company, my company, we both team up and we'll do a deal. You have to be aware that in a joint venture, in the event of a lawsuit, it is 100% joint and several liability, meaning if a lawsuit comes up, they could sue you and me, regardless of my percentage of ownership. I could be 100% liable. You can also be 100% liable. So there is really no way to limit liability in these joint ventures unless you have an LLC. But again, there's certain risks that I'll take, knowing what risks are out there. And if we're just going to do one deal together, I really don't want to have an LLC. We could certainly team up and just do a joint venture agreement that says I'm putting in this, you're putting in that. When the property sells, I get this, you get that. We can certainly do that, but it's best to have the LLC in place. Now, a lot of people will say, okay, we'll try this out. Let's go ahead and start this business. We'll team up together. If it works on this deal, then we'll do another deal. But again, we got to make sure that we are documenting the heck out of everything, because if we don't have everything in writing, we can have huge problems later on. So we can do joint ventures, but just be mindful of the fact that if it's something serious, an LLC is going to cost you around $1,000, $1,500. Get an LLC set up, do it right. People want to step over dollars to pick up dimes when they say, oh, I don't want to pay for another LLC. I don't have to have another tax return to file. Wait until a problem comes up. That would be the least expensive thing you could have and should have done, was to go ahead and set up an LLC to represent that joint venture for that situation. So something to keep in mind. Can it be done? Yes. Is it the best way to do it? No. And think about the amount of money you're going to be making and the risks that are involved before you make these decisions. Now, if you're doing rental properties, completely different ball game. And I see this a lot, especially with commercial property, where we have partners that are coming together to do deals. And as this happens, this is the simplest way that we do it. We do not use S corporations to receive profits from passive income. Passive income is automatically offset by passive losses. Therefore, we do not want to run that money through an LLC taxed as an S corp. It will create tax problems. Can it be done? Yes. Is it the best way to do it? No. So you personally can own a portion of an LLC taxed as a partnership that is buying rental properties. So the LLC is going to document the money was made. We have the automatic depreciation losses and the profits we're giving to each partner via a K-1. Remember, rent is not subject to Social Security and Medicare tax. So with that in mind, I don't need to run that money through an S corporation. I can send it to myself personally, and I would just report that on my personal tax return. Give that information to my CPA with the K-1 showing the amount of money that I got. So there's certain times where it's good to run the money through an S corp, certain times that it's not. And the only exception to this rule is if you are doing Airbnbs. If you have a property that is an Airbnb, I can, because Airbnbs, the income is subject to Social Security and Medicare tax. So because it is a short-term rental, it's treated like a hotel business, for example, where that is active income. Even though I'm collecting rent, it's a short-term rent subject to state, federal, and Social Security and Medicare tax. So Airbnb income, it is good to run through an LLC taxed as an S corp, where just a regular long-term rental, we keep it separate. So those are my pieces of information, Chris, and my wisdom to impart on you and your group and putting these together. And I want to find out if we had any questions that we can cover, or if anyone needs some specific help, you have some specific things you need help with, certainly you can contact my office and we can talk individually about what you're doing and how you're doing it and see if we can help you.
Perfect. There's definitely some questions. So, Annette was saying with all this stuff, for a lot of people, it sounds really complex. Do they need a lawyer to draw up all these agreements?
Yeah, I always recommend having a lawyer. In our office, we have a lawyer that drafts the agreements and makes sure they're done properly. There's a lot of things that you can do on your own. If you want to do certain agreements on you sure can. But I would rather have a licensed attorney do it that deals with these things. And I think, I don't know, I can share it with you, but our attorney has been through these issues with partnerships, has experience with all these things. So sometimes they say, every wife on the block has a new kitchen except for the carpenter's wife. And attorneys, a lot of times, they do business. They know they should do these things, but they don't always do it. And Kurt shared with me a long time ago, he had an issue with the partnership. And so he is a huge proponent of doing it and a huge proponent of making sure it gets done right.
Yeah. And, I want to say one other thing to something you said. This just happened, literally. Somebody, used a company to set up an LLC, and it was one of the cheaper companies. So, they went with them because it was lower cost. Let's just say one company's $1,500 and this company was $600. So like, oh, I'm going to go with the $600 company. So a year goes by, and then all of a sudden they're filing something happened. And someone pointed out that the publication, this is a New York LLC, the publication wasn't recorded and wasn't filed. So, and Adam, I'd like you to explain that in a second, what that means when you don't have the publication filed. But then this person had to go back to this company and say, hey, listen, we paid for the LLC to be set up, but you didn't do it all. You didn't do this publication. And the guy says to her, he says, that wasn't part of the package you bought. And this person's just like, I bought a package to set up an LLC. What do you mean it wasn't part of it? Well, the publication is extra. Well, how much extra? Ready for this? $650 extra. So a whole year went by. They didn't even have a valid entity set up because the publication wasn't done. Adam, correct me, I'm not an expert in that. And then they had to go back and spend another $650. So now it costs them $1,250 instead of the $1,500. And I bet you any money the operating agreement isn't correct. I bet you it's just a standardized operating agreement with no bells and whistles. So if you got a partner, your operating agreement should have the specifications of duties and everything else, the buy, sell, all that. But none of that was included because, quote unquote, they bought the cheap package. Can you explain the publication part? Because I think a lot of people miss that. I know it's a big thing here in New York.
Yeah, so in the state of New York, when we form an LLC, we register the LLC with the Secretary of State, and then you get a notice in the mail. And by the way, registering a foreign entity, because I was set up in Nevada, we register it with New York, and it's $250 registration fee, which is kind of on the higher side. It's not the highest, but it's a little bit higher to register there. But once you pay the $250, then the state sends you a notice that says, hey, you must publish in the newspaper, in the legal section of a newspaper, that you are operating as an LLC. And I think it's a 6-week publication. And that's going to range anywhere from $300 to $1,600, depending on which publication you choose to use. So, of course, this is the most archaic thing, because in today's day and age, it used to be you had to publish that you're operating as an LLC, and I'm sure there was some reasons behind it before the internet. But now we have Google. I can look a company up in 2 seconds. I can see anything. So why they require this, I don't know, but New York requires it. It's also important to know, for example, we do an S election in New York and New Jersey. They require special S elections where every other state follows the federal guidelines, not New York and not New Jersey. So there's always little nuances that people normally learn the hard way. Like you said, what happens after 90 days, if you don't do the publication, your entity goes into a delinquent status where now you have to pay extra fees just to get it back in good standing. So it's very important it's done right from the beginning.
Yeah, very, very good point. Another question here is, if you incur a significant loss for your LLC, can you use that loss carry forward in your personal income tax owed in upcoming years, especially since there may not be another business started?
This is a question that it has to be addressed with your CPA. There are loss limitations depending on the type of loss that it is. So, for example, if you lose money in the stock market, you're typically limited to $3,000 in losses. And it's going to carry forward for the next 100 years until you use up all your losses. So you really should ask your CPA, here's my situation. Can I use these up? Or what's the best way to use these up? And it's all depending on the type of income that or the type of losses, whether it's active or passive. Those are things your CPA is going to have to address with you.
Yeah, and Elizabeth, I'll just go one more round on that. So, usually you can carry forward losses. I've been doing it for years. And then this year I got slapped with a big tax bill. As many of you know, I buy low and I sell high. So I've been selling a lot of my real estate. And I made a critical error. I always save money for taxes. When I sell a piece of property, I put X amount into just a segregated account to pay the taxes. But what I forgot about is, number one, I forgot that for years I've been taking the depreciation on all those properties. And it was great. Like, hey, I took the depreciation, it limited the amount of taxes I had to pay each year until I sold those properties. So, we always love the depreciation. We constantly hear about that. It's such a good thing until you decide to sell the property. Then all of a sudden, the big man with the big hat with the little stars, red, white, and blue, comes a knocking and says, hey, we gave you all those deductions on that depreciation. Now you sold the property. We want all that money back. So now I had to pay all this depreciation that I took for years all in one shot. It made me really think about it. It made me think about, are we really getting a depreciation deduction? Or are we literally just kicking the can down the line? And you can decide that for however you want. I mean, some of you are like, I'm never going to sell the property. Great. Well, when you're gone, if you don't have the proper structure of your company with your children or the wills and the trust, maybe your children or your spouse want to sell the property. Somebody's going to pay the big guy. Okay. And that big check sucks. I just got hit with it. So just make sure you understand, how that stuff works. Don't get caught in the trap that I did. And also just, the carry forward losses, make sure you check with a good CPA. If you're in real estate, get yourself a good CPA that deals in real estate. If you sit down with your CPA and your CPA doesn't really know the lingo for real estate, for assignments and all this stuff, and maybe it's not the right CPA. Don't learn the hard way on that. Tom Thompson was saying, he says, what did you say, S collection? Can you just hit on that S collection again?
Oh, S election.
Or yeah, that's what I thought it was. And can you
Yes.
go back one slide?
Yep.
There we go.
This one here?
No, that one's fine. Just the graphic there. And then, yeah, S election. Can you just hit on that again? Because I know I used to be confused about, what that meant for the S election. I mean, when people say S election, our minds, the rookie minds that aren't in this LLC world think S corp. So it's different. Can you just hit on that just real quick?
Yeah. So when we form the LLC, we're going to obtain your federal tax ID number from the IRS. And I'm going to use your name and your social security number, and they're going to give me a tax ID number. Well, now I've got that tax ID number. If I do nothing, my LLC is disregarded for tax purpose. It does not have to file a separate return. All the profits and losses would flow through to me personally, whether it's a Schedule C, Schedule E. The LLC doesn't file a return. For active income producing businesses, we want to elect to be taxed as an S corporation. You will complete Form 2553 with the IRS, or have your CPA do the 2553. We're electing for us to be taxed as an S corporation, where now we get some different benefits. Whereas previously, and I just like the example of 100,000. If my business made 100,000 and I am in an LLC that is disregarded, I am subject to state, federal, and Social Security and Medicare tax on 100 grand. That is $15,300 that I will pay for Social Security and Medicare. If I run the same money through the LLC taxed as an S corp, here we go, the IRS rules change. The IRS says you must take a reasonable salary from your business. That is the W-2. Reasonable is typically no less than 30% of your net profit. So in this example, we've got 30,000 as a W-2. I'm paying my Social Security and Medicare tax on my W-2, which drops from 15,300 down to 4,590. The other $70,000 is still your money, but the IRS allows you to pay that to yourself as a K-1 distribution, which is not subject to Social Security and Medicare tax. So having that S election means your LLC is now expected to file Form 1120S. And the 1120S is a business return. We still have to keep track of expenses. We still have to have good documentation, but it eliminates the Schedule C, allows us to save money in taxes. And one thing that I didn't even think about, so a lot of people do home offices. And I just got off the phone earlier, a lady that she has not filed her taxes for 2016, 17, 18, 19, and 20. So independent contractor, making good $20,000 a month, not doing bad, but hasn't filed taxes. And now she's starting to panic and wants to get these things done finally. So I was looking at it and I was talking about things that you're going to need to figure out. Did you have a home office? She said, yes. Well, the problem, if you don't have the LLC taxed as an S corporation, you can certainly write off a home office, but it goes on your personal tax return. Number one, it's a red flag for audits because it's heavily abused. Secondly, is whatever you wrote off as a home office, eventually when you sell your primary residence, all has to be paid back as depreciation recapture, just like the property, your rental properties you sold, Chris. Home office expense, great, we'll give you the deduction, but then when you sell the house, it's all got to be paid back. The new tax plan that went through, if you have an LLC taxed as an S corp, you do not have to claim that on your personal return. Your company can reimburse you for the use of your home office. That's the LLC taxed as an S corp can reimburse you for the use of the home office. You do not have to claim it as income. There is no depreciation recapture, and it's not going on your personal return. So we eliminate those red flags. But when we have to calculate up, they want to see an actual office with office furniture only. It can't be a room that has a day bed and a futon, something like that. They want to see an actual office. But if that office is 10% of the square footage of your home, your company can reimburse you 10% of your monthly payment, including property taxes, HOA dues, association fees, and utilities, electric, gas, water, sewer. It's a pretty good deduction. So these are things that LLC taxed as an S corp, perfect for active income producing business.
Oh, that was really good. Thanks for hitting that. And that's stuff that I wish I knew a while ago. So I've got two questions I'm going to combine into one. So we've got a question that just basically says what I think maybe we kind of missed it in the beginning, but what does NCH do and how can you help, the viewers on the Wealth Webinar series? They're asking, is it consulting? Is it setting up partnerships or taxes? Some people miss that. Can we just hit that one more time as to what you do and what NCH can help them with?
Yeah, so NCH, I'll give you our 30-second commercial, Chris. So it's our 32nd year in business. We have an A+ rating with the Better Business Bureau. The backbone of our company is we form corporations and LLCs. In-house, we have a full legal department. I have one of the best CPA firms in Nevada. We do tax and accounting for business owners and investors all over the country. We have a business credit team. If you want to help build business credit separate from personal, we have a team that does custom business plans. We do estate planning, like the trust and wills. Financial planning, we do self-directed IRAs and self-directed 401ks. So, and I'm not a financial planner or financial advisor, so I am not the guy to tell you what you can or should invest your money in. I am an expert on prohibited transactions, what the IRS says you cannot use your money for. So when you're self-directing, a lot of times you'll get checkbook control over your retirement funds. One wrong check written out, or you do something incorrect, and you'll get whacked with the penalties are severe. So making sure you do things right is how we help on that side of things. So that's what we do. We set up home state LLCs. We set up Nevada LLCs. If it's a small company, large company, work with all different types of businesses, but we actually specialize in working with real estate investors as well. So that's always helpful.
Love it. And then Ann had a question. She says, I have a LLC in Nevada, but I live in New York. I was told I can do real estate in all states. I didn't register in New York. Does that mean I cannot buy properties to hold in New York? I can only wholesale.
Well, this is a important thing is that your LLC must register appropriately with the state you are doing business in. And when we talk about wholesaling, for example, the argument being, well, I didn't take title to the property. I just got it under contract. Do I really need to register with New York? And if you live in New York, well, first of all, every LLC that I ever set up, I always recommend that we must register the LLC with the state you live if you're doing an active business, always. So that's number one. Number two is from if you're wholesaling, if you did one deal in New Jersey, for example, and it's just kind of a one-off, you didn't take title to it, technically I don't have to register with New Jersey for that one wholesale deal, so I didn't take title to the property. But we do have to do apportionment, and I do have to pay taxes appropriately in the state where we make the money. So the problem is if you're not registered with New York and any lawsuit comes up, your LLC is not properly registered there. Most states won't even recognize you as an LLC, and you've done all for naught because you will be personally liable if you're not doing business properly. So the answer, yes, you should be registering with New York. If you live there or if you're doing multiple deals there, absolutely register there.
Yeah, and probably the best thing to do is whoever set your LLC up, I would just call them and make sure it's registered properly. Otherwise, just set up a call with someone at NCH and just have them pull it up because they can look at it and they can make sure that it is registered properly and you're doing this the right way. Hey, Adam, one other thing too I wanted to point out, and it was brought up by somebody. You know you got a typo on this page,
I
right?
see it right now.
So that's
consultation.
Consultation. It's just a different language. No big.
That's what we get when I type things.
Let's see. I had one other question. I just lost it here. Oh, Darius had a good one. So, and this is going to be tough to do in 30 seconds, but can you do a 30-second commercial of what you can't invest in using your self-directed IRA? And he already knows he can't invest in life insurance.
Yeah, so go to IRS publication 4975, and there's a list of prohibited transactions on the IRS website. IRC section 4975. Basically, anything that benefits you personally, you cannot do. If it benefits your personal or your vertical lineage, you cannot do. So anything that benefits me personally, my mom, dad, grandma, grandpa, kids or grandkids, is prohibited. If it does not affect them, so for example, if I bought a rental property with my retirement account, I can't live there. I can't vacation there. I can't do anything there. Uh, However, I could rent it to my brother, sister, cousin, uncle, anybody outside my vertical lineage is okay. So, and we actually have if you have a self-directed retirement account or you're looking into that, we have a pretty good list here at the office of things that the IRS publication really doesn't cover. We cover it as it relates to real estate. Because if you're looking to invest in stocks, bonds, and mutual funds, those are your Charles Schwabs and the banks that can do those type of things. Where having a self-directed account comes in is when you're looking to do things outside. If you want to be a private lender, you want to buy rental properties. Those are the type of things where having the self-directed account comes in.
Yeah, Adam, this is a great question by Ricky, and we get asked this all the time. Stephen, I think, probably gets this question 3 times a week. He's saying, can I purchase short-term rental properties with a self-directed IRA? It's kind of a yes, no answer, but I'll let you handle that.
Yeah, it's a gray area. So what I've learned is that basically anything that you do personally that would generate self-employment tax could present what's called a UBIT tax inside of your retirement account. So if you're actively running a business out of your retirement account, that is subject, that income is subject to Social Security and Medicare. You could be subject to UBIT. It's called unrelated business. I'm sorry, in this one, yes, unrelated business income tax, which starts when you make $900 or more, you're paying 10%, and it very quickly climbs to 37%. When you hit $12,500 of income or more, you're paying 37% federal tax on any income that comes into that business. That hurts. So if you're subject to Social Security and Medicare personally, your retirement account could be subject to the UDFI tax for that type of income. However, a long-term rental is not subject to Social Security and Medicare. It would absolutely be fine. There would be no concern about the UDFI. Airbnbs are weird because they want to charge you the self-employment tax, even though you could have it set up to be completely passive. We always run that risk on the Airbnb. We don't know yet. And until we see a court case on it and goes through the tax courts, the answer, we don't know yet. Theoretically, it would be subject to UDFI because it has the Social Security and Medicare, but we don't know.
That's a good answer. Angie said, my wife and I started our LLC recently and are only investing money so far. We will only receive a simple interest gain on our money. If we don't use the LLC at all, are we able to be in the category for not having to pay tax for the LLC being unused? That's actually from Josh, Angie's husband.
Okay, so if your LLC, you should file a tax return. If that LLC, I'm assuming, is disregarded, it will not file a separate tax return. All the profits and losses will just flow through to your personal return on your Schedule A, Schedule E, Schedule D, wherever it's going to show up. But if you have an LLC taxed as an S corporation, even if you make no money, which, by the way, if I have interest income, I would never make the S election because it's interest income. But if it's active income, if you have an LLC taxed as an S corp, the return is due 1 month before your personal. If you're not ready to file, please file an extension. Because if you fail to file the return and you fail to file an extension, even if you make no money, you're going to get penalized $195 per month per shareholder for a maximum of 12 months for not filing something. So at minimum, if your company is formed and it doesn't do anything, at minimum, file a non-activity return just so the IRS doesn't think you forgot or simply didn't file.
Good advice. Yeah, don't give the IRS any more penalties and fees because they're just hiring more people to audit all of your books and records to squeeze out every last cent they can to pay for everything that is going on now. Anyway, not sour at all of anything about what's happening with taxes. Yeah, right. So, Adam, I think they got all the questions. Folks, was that not, what do you guys think of that? Like, that was some great information. I mean, the stuff that, we need to know that we don't know was just laid out in the period of about a little less than an hour. Partnerships are such a common thing, especially in real estate, hey, you can do the rehab. Hey, I got the money, let's partner. But then you fail, you jump right into it, and then you fail to do the planning. And then all of a sudden something doesn't go right. And then you want out and nothing's set up. So like sometimes just taking a step back and doing the proper planning on that kind of stuff will save you an awful lot of money, headaches, and who knows what else if you do it. So, NCH and Adam, are great. I've set up lots of LLCs with them. When I have issues, like I change addresses or we just bought out a partner from one of our companies and we had everything set up the right way. It was so clean. Like, listen, I just did this. Adam, you'd be proud. I had a partner and that partner moved away. And then, we had this agreement and the buy, sell and everything. So I already knew how much to buy my partner out for. So what I did is I set up a payment structure to buy this partner out. And I made the last payment. I called Lisa over at NCH and said, hey, Lisa, I need to get this partner removed from the operating agreement, removed from the LLC, and then I need something in writing, I don't know what it's called, that I can give the bank to have that partner removed from the business loan. One call, maybe one email and a couple of forms I had to sign. It was done. I had the form in my hand. I sent it over to the bank. The bank took, the partner off of the loan, which is what he wanted. If it didn't go well, if it was a bad breakup of a partnership, I might have just left them on the loan, but it wasn't. It was a very good partnership while it lasted. We went separate ways. Like, how many of you want a clean break in a partnership like that, where everything's laid out? It's not, you get to the finish line, you're like, all right, well, I know you want to exit this. This isn't really working out. So like, how much, what's it going to take to buy out? And he puts, the little pinky finger. You guys remember that from Austin Powers? And he says, $1 billion. And you're like, I don't think so. You don't have it in writing. So, hey, now all of a sudden you got yourself a problem. And like, I didn't, because NCH set all this stuff up for me the proper way. So again, cost, a lot of people are like, oh, $600 for the LLC versus $1,500. Cost is only an issue in the absence of value. The value is your peace of mind, your headache, all the things you're going to save because it's done properly, so that when you actually need to fall back on it, you're not circling back saying, oh my gosh, that wasn't done right, or have attorneys saying, oh, you left some loopholes that we're going to go in and going to, take everything. Just do it the right way, folks. Whoops, sorry, 2 more questions popped up. I'm a sole proprietor. I have averaged $10,000 a year for the last 10 years. Someone told me if I make under $15,000, I don't need to file a tax return. Then I find out that that's not true. Let's see, scared to file anything now. Well, that's kind of tax advice. I don't know if you want to hit that. That's sort of borderline like CPA question.
I will hit it. So the answer is if you make more than $600 a year, basically what the IRS rules are that you must get a 1099 if you're a sole proprietorship, a partnership, a general partnership, an LLC taxed as a partnership, or an LLC that is disregarded. We have to issue those people 1099s. What that means, if I pay you $600 or more, I have to put that in my books for my records, and I have to send it to the IRS that says, hey, I paid this person more than $600, because then the IRS is expecting it to show up on your return. So the $10,000 that you've been making as a sole proprietor, you should have been reporting that, especially if it is 1099s. So you should have. Now that you probably need some help having someone look at it, because we'll look to see what got reported to the IRS. Normally when we have situations like that, we'll go back 3 years and refile if needed. Generally, they don't go back more than 3 years, but who knows, with these new 85,000 agents, I don't know what the answer is. It's not a huge amount of money. $10,000 a year as a sole proprietor is not going to kill anybody, but you should have been reporting it, and you should have been paying the appropriate taxes on that money.
He said he never received a 1099. Maybe that's why he never got any IRS notices. Could be.
Could be.
but they are just like me with those deferred, like it's just appreciation. It catches up with you. So don't ever think that like, oh, glad they didn't find out about that. What's the look back period right now? 7 years?
Well, I just had a friend that got the California Franchise Tax Board just audited him last December from 2006.
Oh my gosh.
Yeah.
So in other words, they're just making up the rules as they go with how far they want to look back.
But generally, we always say keep your records for 7 years or forever, whichever is greater. But generally, they wouldn't go back more than 7 years. Typically, they don't go back more than 3. But again, it's so easy to keep good records and get good systems in place. You really should.
Oh my gosh. And then one question, does NCH provide a service where you would offer like something to review their current LLCs, operating agreements, buy sells to see if it's structured properly and give advice?
I don't have anything specifically for that. You can certainly call my office, talk with one of our experts, find out what you have going on and how you've structured it. It might be fine, but we would have to talk to you and see what you have. And if you have agreements, you can send them over and we can always review them, but I don't have really a mechanism to charge you for it.
Yeah, I think she was just looking for someone to look at what she's got and say, okay, this is good, or hey, we need to make these changes. So you guys could do that for her?
We can do that.
All right, fantastic. And let's see, I haven't filed some props and never filed personally for 10 years. Unanimous, stay unanimous. Because yeah, if you haven't filed for 10 years, you probably should have a little anxiety, or maybe get a good CPA to start getting that taken care of, because it's a long time to go. That's, I don't really have any advice for you. Anything you'd say that would be different than what I just said on that one?
Yeah, and again, if you haven't filed for 10 years, generally what we would do is we go back 3 years and go ahead and file and see what happens.
Right?
Yeah. But it also depends if you were a W-2. If you didn't file and you had been having taxes taken out, you probably should have got a refund, but you didn't file. So guess what? They owe you money that you're never going to get. So that's why we'll go back 3 years, because especially if you're W-2, they probably owe you some money. You might owe them some money, but I'd rather get that taken care of now versus waiting, because if you get audited now, we know what's going to happen. They never audit you the first year. They always go back 3 or 4 years previously. And then you know what's coming down the pipe if you've been operating things incorrectly. So I'd rather be proactive. I'd rather go to them versus them having come to you.
Absolutely. Well, Adam, this has been awesome. Thank you so much for your time. And everybody watching, listen, I got to talk about one additional thing. So August 27th, 28th, and 29th, you've heard me just start talking about this. We're doing an event, and it's like no other event we've ever done. We're literally, the whole team is doubling down on this event to make it so that it's like nothing you've ever attended. It's called The Experience. It's at my house. There's only 25 total seats, of which we have 18 seats left. It's the first night. We're going to do a really nice dinner, and everybody's going to get to know each other. Don't bring your credit card. We got your dinners. Okay. So what you do is you get your flight, you get your hotel, which we're going to give you preferred hotels with, different shuttle options. And then you're going to show up to the dinner. The next day, we're going to my house and we're going to spend the entire day there, but we're not going to sit there and teach you anything. Okay. So we're not going to stand in front, and the mentors, and I'm going to tell you who some of them are. We're not going to sit there and teach you things. What we're going to do is have you tell us. And who is us? It's myself. It's going to be Robert Sislo for marketing. It's going to be Chris Rude for mindset and business. It's going to be Randy Garn, who's just shy of a billionaire, has bought and sold and exited multi-$100 million deals. It's Brandon Steiner, who bought the Yankees Stadium, and one other guest that I can't tell you, but he's a celebrity that a movie was written about, where you're actually going to be able to watch the movie, listen to him tell the story about it, and ask questions. Those are going to be the people that are going to be listening to you tell them what you need. You're going to be there, one of 25 lucky people, telling us how you need help. What in your business do you want? What are you trying to do? What are your goals? What are your problems? And the panel of experts, the mentors and coaches, people that you'd never have access to, are going to help guide you over the course of 3 days to exactly where you need to be. And in that whole experience, okay, we're going to make some memories that you're never going to forget. One of which will be Saturday evening. Can't tell you exactly what it is, but it's something you'll never, ever have access to again in your lifetime. It involves a celebrity that a movie was written about. I'm not going to go any further, but I've heard him speak. It is one of the most powerful, motivating speeches you'll ever hear. And you're going to be there in the room for 3 days with this person. Then the third day, you're going to have Brandon Steiner talking to you. We're going to do a bunch of team activities. We're going to take the 25, break us all up into groups, and we're going to do some fun things at a lake, a private lake that no one but the residents, including me, have access to this lake. We're going to do canoe races. We're going to jump off cliffs if that's your thing. And we're going to spend the entire day building team type events where, like racing canoes. Sounds fun, right? But you're going to do it in a team fashion, just like you would do in your business. And we're going to have a ton of fun doing it. There's 18 seats left. So we're going to put the link up. I actually just put it up. If you have interest, you can either go on and grab one of the seats or set up a call with Steven to ask more about the event to learn, because there's a lot more than what I just explained. I can't stress enough that when these seats are gone, they're gone. It's at my house. Trust me, no more than 25 people are coming to my house. And I want the right people. So if you're here now, chances are you're the right person. Okay. But we want to make sure that if I'm inviting you into my house, into my environment, around my family, that you are the kind of person that I want at the experience. So book a call with Steven. Let's talk about it. And let's see if this event can help guide you and get you where you need to be and set and create some experiences and some memories that will last a lifetime. So folks, that's the experience. I just wanted to point that out. I hope to see some of you there. Actually, I already know a couple of the names. You're going to be there. And I hope some of you fill the rest of those 18 seats left. And we see you August 27th, 28th, and 29th. And Adam, thank you so much for your time. And everybody else, I'm going to put Adam's info up one more time so you guys can get a hold of him and his team, and he can help guide you in your partnership structure, your LLCs, and all those other things that he mentioned that NCH and Adam do. So right there, bingo. Perfect, Adam. Thanks so much, man.
Hey, thanks everyone for your time. Have a great day.